Hi, and welcome to this month's Trade Floor Update. Before launching in, I just wanted to acknowledge that we recognise this is a tough time for all of our clients, both professionally and personally. We are doing our best to keep clients as up to date and informed as possible through this period, and we certainly value your support. I'm joined this month by Portfolio Manager Aditya Thacker. Welcome, Aditya.
Hi Hayden, it's great to be here. I hope everyone who has tuned in is well and keeping safe.
Aditya, from an investment standpoint, we've obviously seen considerable pricing dislocation in what we refer to as spread sectors or credit markets. Put another way, the valuations on these securities have cheapened significantly. This mainly occurred throughout March, and we have seen a small rebound in April. Do we still see value in spread sectors, and if so, whereabouts in particular?
Well, with the enormous policy response from fiscal and monetary authorities, we have seen a significant reduction in market volatility and a solid retracement in risk assets. As seen on the top right chart of slide 1, we can see that investment grade spreads have retraced about 50 to 60% of the widening we saw in March, aided by direct support by planned Fed and ECB QE purchases of investment grade credit. Now, high yield has lagged the move, retracing only around 40% of the March widening. But in general, we see valuations, carry, and technicals for investment grade credit have certainly improved, as you can see on slide 2. However, we do remain cautious lower down the quality spectrum, with potential for defaults to be a source of re-emerging volatility. We are therefore focusing on defensive, non-cyclical sectors like telecommunications, utilities, healthcare, and consumer staples, and we're remaining cautious on cyclical names in energy, autos, and retailers, and we have a preference for developed markets over EM markets currently.
Speaking of defensive positioning, I have had a lot of client conversations recently about low rates and the role of core bonds or interest rate risk in portfolios. Aditya, do you still see value in rates at these low levels, and do traditional bonds still have a role to play in portfolios?
Well, our expectation is for a slow, uneven, U-shaped recovery across regions from the coronavirus pandemic. And this will likely mean a prolonged period of negative output gaps or excess spare capacity, which will keep central banks firmly on hold and keep them engaged in QE for quite some time. Now, this should anchor bond yields and keep them relatively range-bound, while still providing the traditional diversification benefit during risk-off periods, like in March. Now, this will be especially evident should we see a second wave of the virus and renewed lockdowns. We can see the negative correlation to risk and hence the diversification benefits of bonds very clearly in slide 3. Now, more medium term, the likelihood of the pandemic causing further downside pressure to real equilibrium interest rates is high, and this will serve to further entrench this lower for longer environment for interest rates.
Aditya, given the challenging macroeconomic backdrop, can you comment on some of the risks we should be thinking about as bond investors? More specifically, are there any major areas of concern for us right now?
Now, in terms of downside risks to bonds, we can't rule out an unintended hawkish policy mistake, much like the Bernanke taper tantrum back in 2013. And secondly, geopolitics will continue to be a risk to watch very carefully, especially if the response to the pandemic speeds up anti-globalization via rethinking of strategic supply chains, which could be a source of inflationary pressure. But overall, these are tail risks and not our base case, and still quite possibly overwhelmed by the macro impact of the pandemic on lost output.
And finally, in terms of looking forward, can you perhaps make some comment on some of the positive actions the desk is taking to position portfolios for the next 6 to 12 months?
So as I alluded to earlier, we retain a cautious defensive bias to our portfolios, maintaining a focus on retaining high liquidity and structural seniority. Put simply, when there's a flood, we want to be on the top floor. So when we think about adding risk, we currently have a preference to add to higher grade, more liquid expressions of spread product, where there is less scope for jump to default risk, but a good chance for spread performance and capital price appreciation and improved liquidity conditions via central bank support. So this includes sectors like semi-governments, supras, and high-grade credit in non-cyclical sectors, as I've outlined earlier. And to end on a positive note, we've been glad to see a very good reaction from corporate Australia in terms of a proactive response to the COVID crisis. We've seen many companies either reduce or cut dividends, increase access to liquidity, and we've seen a huge amount of equity raises in the prior 2 months, something in the order of 15 billion, which is helping to shore up corporate balance sheets in Australia. So we continue to like Aussie dollar, Aussie corporate credit, particularly in the sectors that I mentioned earlier.
Well, thanks very much, Aditya. That really does help a lot. And thank you for watching as well. If you do have any further questions, I would encourage you to get in touch with your local account manager, who will be more than happy to help out. With that, stay safe and bye for now.